I think there's going to be a 10-year reckoning while we sort out how we do that in the future. And I think it's going to be decidedly unpleasant. The decade 1970 to 1980 saw the purchasing power of the U.S. dollar decline by 75%. Mm-hmm. It wouldn't surprise me at all to see that happen in the next 10 years. So you're cruising along, making $100,000 a year, thinking you're doing very well. And when you're budgeting for yourself in 2035, think about the fact that $100,000 will buy you $25,000 worth of goods and services. So plan your savings and your retirement accordingly.
Between 1970 and 1980, the U.S. economy experienced a turbulent period marked by stagnation, high inflation, and significant policy changes. This era, often associated with stagflation, saw the unusual combination of slow economic growth, rising unemployment, and persistently high inflation. During this time, the Federal Reserve struggled to contain inflation, which reached double digits by the end of the decade. Adding to the economic challenges was the dismantling of the Bretton Woods system in 1971, when President Nixon ended the dollar's convertibility to gold. This led to floating exchange rates and a devaluation of the dollar, further complicating the economic landscape. Renowned precious metals analyst Rick Rule predicts the U.S. economy is due for another 10-year reckoning. According to Rick, the coming decade, like the 70s, will be marked by high inflation, a stagnation in economic growth, and high unemployment. As a result of these expectations, Rick is extremely bullish on gold prices, as he envisions a quadrupling in the metal's demand and price in the coming years. During the inflationary decade between 1970 and 1980, gold prices experienced a dramatic increase, reflecting its role as a hedge against inflation and economic uncertainty. At the start of the 1970s, gold was priced at around $35 per ounce due to the fixed rate established under the Bretton Woods system. However, this changed in 1971 when President Richard Nixon ended the dollar's convertibility to gold, effectively dismantling the Bretton Woods system and allowing gold to trade freely in the market. Once gold prices were no longer fixed, they began to rise significantly. By the end of the decade, gold prices skyrocketed, peaking at an all-time high of approximately $850 per ounce in January 1980. This surge represented a more than 20-fold increase in its value from the beginning of the decade. Rick's prediction for gold prices in the coming decade mirrors its performance in the 70s, as he envisions the precious metals' performance reverting to mean. We will present clips from Rick's recent discussion with Julia LaRoche. But before we do, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos. We appreciate the support and hope you enjoy the video.
Gold prices usually rise when people are concerned about the maintenance of purchasing power in fiat currency denominated savings instruments. On a global basis, the world's reserve currency is the U.S., and by default, the world's preeminent savings instrument is the U.S. 10-year Treasury. So let's look at the arithmetic just around the Treasury. The first thing to say is that the current deterioration of the purchasing power of the U.S. dollars is measured conventionally by something called the CPI, the Consumer Price Index. And I would argue with you that the CPI is a very inefficient measure of the deterioration of the purchasing power of the U.S. dollar. If you believe the CPI, it would suggest that the deterioration, Julia, of your savings is progressing along at about 2.6% per annum. I think if you examined your own personal finances in the period, say 2000 to 2025, a 5-year period, and you thought about how your health insurance premiums had changed, or how the price of your groceries had changed, or how, if you're a homeowner, mortgage interest rates have doubled, or if you're a renter, what has happened to your rents? When I run that same exercise myself, and by the way, I'm an old cheapskate who doesn't spend very much, I find that a deterioration of my purchasing power is more like 7.5% per annum than it is 2.6% per annum. Mm-hmm. I would urge your listeners to think about their own spending patterns and whether 2.6 represents the level of the deterioration of the purchasing power of their savings that they've experienced. If you use the CPI number, the arithmetic around the US 10-year Treasury isn't bad. You're getting paid 4.5% a year in a currency where your purchasing power is declining by 2.6%, which means you're getting almost 2% real yield. If by contrast you use the 7.5% number, that is, you're getting paid 4.5 in a currency that's depreciating by 7.5, you're losing 3% a year. The concept of investing in a riskless asset, a US 10-year Treasury, where your purchasing power declines by 3% a year, compounded over 10 years, is not very attractive. Let me restate that. It's extremely unattractive. And this is precisely the circumstance where gold does well.
Yeah.
And gold has done well.
Yes.
The second part of gold isn't so much arithmetic as narrative, which is to say the preeminent buyers of gold in the last 3.5 years haven't, in fact, been Americans concerned about the deterioration of their savings, but rather foreign governments who object to two things: the weaponization of the US dollar and the weaponization of the SWIFT banking system, which is to say the US government's attempt to use the US dollar to enforce its policy prerogatives elsewhere. Other countries object to that. And two, a return to that arithmetic. If you're China and you have $3 trillion in US treasuries, and you look at being paid 4.5% in a currency where the purchasing power is declining by 7.5%, it seems like a lousy deal, particularly when that's compared and contrasted with selling your U.S. treasuries and using the money to make investments in your own economy. The Chinese, of course, have done both, made investments in their own economy and bought gold. And I think what you're seeing there is the hegemony of the U.S. dollar challenged, often in favor of gold. One final piece of arithmetic, Julia, which we talked about 3 months ago, but some of your listeners won't have had the good sense to listen to us 3 months ago. That is this: gold is really, really, really underowned historically. J.P. Morgan Chase suggests that the market share of precious metals and precious metals related securities is less than 0.5% of total savings and investment assets in the United States. In other words, an infinitesimal market share. The 4-decade mean market share is estimated by J.P. Morgan Chase to be 2%. So gold doesn't have to win the war against the U.S. dollar. Gold doesn't have to demolish the treasury markets like some gold bugs suggest. All it needs to do is return to mean. If it returns to mean, demand for this asset class increases fourfold. One can only guess what a fourfold increase in demand would do to a commodity where increases in supply are extremely limited. And that's precisely what I think is going to happen and continue to happen. I don't own gold because I think it might go from 2,700 to 3,000. I own gold because I'm afraid it's going to go to 9 or 10,000. Why do I say that? The last time that we had sustained deterioration in the purchasing power of the U.S. dollar was the decade of the 1970s. In that period, 1970 to 1980, back to arithmetic, according to the Office of Management and Budget, the U.S. dollar lost in excess of 75% of its purchasing power, which is to say, at the beginning of the decade, $1,000 worth of goods and services, by the end of the decade would have cost you $4,000 to buy. During that period, the gold price went from $35, admittedly a price-controlled $35, to $850. And I think passes prologue. I don't see any reason, any way, with the on-balance sheet liabilities of the U.S. government at $36 trillion, and with the government's estimate of the net present value of off-balance sheet liabilities, mostly entitlements, Medicare, Medicaid, Social Security, exceeding $100 trillion, that is to say, with net government debt over $130 trillion, I don't see any way out of this circumstance other than inflating away the net present value of those obligations, just like the decade of the 70s. And that means likely not merely higher, but much higher gold prices.
At the moment, central banks are the biggest buyers of gold. In recent years, the apex banks have significantly increased their gold purchases, marking some of the highest levels in history. In 2022, central banks collectively added 1,082 tons of gold to their reserves, setting a new annual record. This robust purchasing trend continued into 2023, with an additional 1,037 tons acquired, making it the second highest annual total on record. The momentum persisted into 2024. In the first quarter alone, central banks purchased a net total of 290 tons of gold, marking the strongest start to any year on record. The World Gold Council's 2024 Central Bank Gold Reserve Survey, conducted between February and April 2024, revealed that 29% of central bank respondents intended to increase their gold reserves over the next 12 months. This intention is primarily driven by a desire to rebalance reserves, domestic gold production considerations, and financial market concerns, including higher crisis risks and rising inflation. Rick believes other investors, institutional and retail, will soon begin to share these concerns on a massive scale as the value of fiat currencies like the US dollar gets further eroded and investors seek shelter in the best inflation hedge asset. Let's get back to Rick's interview.
The decade of the 1970s and late 1960s was in many senses unpleasant. People on fixed incomes, people who relied on their Social Security, found themselves getting Social Security, but they found that their check every month bought less than it bought the month before. When savers took control of the interest rate market, people found that the interest rate paid on their first mortgages went from 5.5% to 17.5% or 18%. Pretty unpleasant. And people who owned long bonds got killed. Somebody who owned a really riskless instrument, which is to say a 30-year US Treasury, where their income was guaranteed for 30 years, found that the capitalized value of their 30-year bond in the decade 1970 to 1980 declined by 70%. So holders of long-term debt got massacred. People on fixed incomes got massacred. Salary earners, where their skill set didn't enable them to price their labor relative to the price of capital. That is to say, employees that didn't have skill sets that allowed them to raise their rates, also in terms of their purchasing power, got massacred. One consequence of that was massive social division in the United States. I'm not saying that we're going to see a return to domestic violence, but I'm not saying that we aren't either. When people are resentful and they're looking for a cause of their resentment, they very seldom look in the mirror. They most commonly look elsewhere. My hope is this. My hope is that my caution around debt and deficits is wrong. Hope is that the requirement for working people that they have contestable skills. I hope that's wrong. My hope is I'm wrong about the gold price. A $9,000 or $10,000 gold price implies a lot of things about the way other assets in society perform. It implies a real change in one's lifestyle. And my lifestyle's great. I would really, really, really like it if I was able to say, God, I got that one wrong. We got through it fine. The debt didn't matter. The deficits didn't matter. Contestability didn't matter. I just don't think that's the case. I'm almost 72 years of age. Medicare, Medicaid, Social Security. My generation voted ourselves all kinds of cool benefits. We took the money, we spent it, and we're leaving you all a bill. These entitlements really are an intergenerational transfer of stolen property. My generation doesn't want to think of themselves as thieves. They want to think about the fact that they paid into these programs over the years. They neglect to understand that with Social Security, as an example, all the money that was paid in was invested in federal IOUs. And that money was spent funding current deficits. When somebody says I paid in, I need to say to them, yes, you did. You did, in fact. And that money was misappropriated. It's gone. The fact that you think you deserve it is interesting, but it's not relevant. And that's going to cause some resentment. First of all, I believe that they're going to tinker around the edges. I believe that the politicians will have no choice but to say to an old rich guy like me, the cap is going to come off your Social Security contribution. That is, the fact that you don't get taxed for Social Security now on income above $160,000, that's going to go away. We're going to tax you on all of it. And then we're going to means test Social Security, which means despite the fact that the cap came off, you ain't going to get it. Yes, we said it was an insurance program, and we lied. It's not an insurance program. It's a transfer program. The second thing they're going to do, and that's okay. There's very few rich people. It's easy for a whole bunch of people to screw a few people. That works. The second thing that they're going to do, and they have to do it, is they're going to have to change the age that people begin to receive their Social Security. When Social Security was enacted, it provided basically poverty level, subsistence level benefits to people 65 years of age and older. The average life expectancy of an American male in those years was 66 years. So it covered you for a year. That's changed now. The average life expectancy of the median American male is about 80 years, up from 65. And you can begin to receive benefits at 62 unless you're disabled, in which case you can receive it earlier. You follow what I'm saying?
Oh, yes, I am.
They're going to have to change that. And people are really, really, really going to be angry about that. Mm-hmm. The final thing, though, because that doesn't matter, changing it around the edges, it really doesn't matter. Like these geniuses, Bernie and AOC and all these people have said, oh, no problem. Tax the billionaires. Well, it gets back to math again. The problem is $100 trillion. And the IRS estimate of the aggregate net worth of American billionaires is $5.6 trillion. So never mind raising their tax. If you stole all their money, you'd solve 5% of the problem. It would not matter. So the way they'll get around it is that they'll honor their nominal obligations to most old guys. Whatever they pay me now, $4,000 a month, something like that, I don't even know. They'll still pay me that. What'll happen, I think, is that if you're supposed to get $4,000, you'll continue to get $4,000. But the $4,000 will buy you $1,000 worth of stuff after 10. In other words, they will not index your tax to inflation, and they'll inflate away the value of your benefit. That's precisely what they did in the decade of the 1970s. That's one of the reasons why the CPI understates the rate of inflation, because the CPI is the benefits escalator on entitlements. It is in their interest to understate inflation.
Gold prices have surged to retest monthly highs of $2,725, driven primarily by escalating geopolitical and economic tensions. The renewed threats of tariffs from U.S. President Donald Trump have unsettled global markets, igniting a flight to safety that has brought gold back into focus as a reliable hedge against uncertainty. Trump's announcement of a potential 25% tariff on Mexico and Canada by February 1st, combined with his rhetoric about imposing tariffs on the European Union to address trade imbalances, has heightened fears of further disruptions to global trade. Additionally, Trump's warning of tariffs on China if Beijing does not approve the TikTok deal adds another layer of unpredictability to already fragile economic relations. These developments have created a risk-off environment, prompting investors to seek refuge in gold, a traditional safe haven asset. Beyond the immediate geopolitical risks, Trump's tariff threats are also fueling broader inflationary concerns. Tariffs often result in higher costs for goods and services, which can ripple through economies and push inflation higher. Gold's historical role as a hedge against inflation makes it particularly attractive in such scenarios, reinforcing its appeal to investors during periods of heightened uncertainty. At the same time, the surge in demand for U.S. government bonds, another safe haven instrument, has pushed yields lower. Lower bond yields reduce the opportunity cost of holding non-yielding assets like gold, further bolstering the metal's price. However, the gold market is not without its challenges. Price volatility is likely to persist, influenced by any developments in trade negotiations or shifts in U.S. policy. For example, a resolution to trade disputes or de-escalation of tariff threats could dampen the risk-off sentiment and curb gold's upward trajectory. Conversely, continued uncertainty or additional geopolitical shocks could propel gold prices to new heights beyond $2,725. Please share your thoughts on Rick Rule's predictions for the U.S. economy and gold prices in the coming years. If you liked this video and want more like it, please give it a thumbs up, subscribe to the channel, and turn on post notifications for more videos like this. We appreciate your support and hope to see you in the next one.